What if the real threat to your future isn't an invading army, but your own currency, quietly following a script that has already killed multiple empires? Rome started with a solid silver coin and slowly turned it into shiny junk. As the silver content collapsed, prices exploded, and soldiers began demanding real goods or gold on top of their pay. The coins still had the emperor's face. They just didn't have the value. Spain hit the jackpot with New World silver, then did what governments do best: spent it on endless wars, imported luxury goods, and bad debt. After 4 sovereign defaults in a few decades, the global superpower of Europe had basically turned itself into a financial warning label. Britain won World War II and lost its balance sheet. The pound was devalued, inflated, and bailed out until the currency that once ran global trade was replaced by the dollar and turned into a case study in imperial decline. Same pattern every time: overspend, borrow, print, inflate, reset. The uncomfortable part is that the United States is now running a very familiar version of that playbook, with the dollar, the currency your salary, savings, and mortgage all depend on. So, the real question isn't whether or not the pattern is real. It's where we are at in it, and how much time is left before everyone realizes the music has stopped, and they are left without a chair. Let's start with Rome. Before getting into dead empires and history, let's bring it back to real life, because this isn't just about dusty coins and old maps. Your dollar buys less every year, but your paycheck isn't keeping up. Your savings account balance goes up, but what you can actually buy with it goes down. If you're saving for retirement, a house, or your kids' college in dollars, the value of that pile is quietly melting. You're not imagining it. There's a reason everything feels more expensive, and your paycheck doesn't stretch like it used to. Here's what's happening under the hood. When governments overspend and then create new money to cover the gap, they dilute the value of every existing dollar. It's a tax that doesn't need a vote, a hearing, or a headline. It just quietly eats your purchasing power. The twist is that this isn't new. This is exactly what Rome, Spain, and Britain did to their money on the way down. The only real difference now is scale. The dollar is the global reserve currency. That status has allowed a lot more overspending and money creation than other empires ever got away with. And if that status cracks, it won't just be a rough couple of months in the stock market. It will be a structural hit to how savings, trade, and wealth work for anyone who lives inside the dollar system. So instead of pretending everything is fine, it makes sense to understand the pattern, and then build a personal defense plan in case the next stages don't look like a happy ending. If all of that already has you a little uneasy about your own money, this is exactly what we dig into here. On this channel, we don't just shout, "Everything's broken." We connect what's happening in the system to what it means for your savings, your debt, and your next move, and we always end with concrete steps you can actually take. So, if you want more breakdowns like this, with a focus on protecting your money in chaotic times, go ahead and subscribe to Money Margins now, and then keep watching, because the next thing you need to see is how this pattern actually plays out step by step. Empires don't destroy their money overnight. They follow a pattern. You can summarize it in 5 words: overspend, borrow, print, inflate, then reset. Here's what that actually looks like. Stage 1, overspend and overpromise. The empire grows and takes on expensive commitments: the military, infrastructure, social programs, layers of bureaucracy. Politicians promise citizens, soldiers, and allies that everything will be funded forever. Early on, the economy is strong, tax revenue is flowing, and the currency is sound. Nobody worries. Stage 2, borrow to hide the gap. Eventually, the bill comes due. Costs start exceeding revenue. Wars get more expensive. The empire ages. Productivity slows. Competitors rise. Instead of cutting back or admitting they overpromised, leaders borrow. Debt piles up. As long as lenders believe the empire is too big to fail, the loans keep coming. On the surface, everything still looks stable. Stage 3, print to plug the hole. At some point, the debt becomes too big to manage with borrowing alone. Interest payments swell. Lenders get nervous or demand higher rates. Now the temptation kicks in. Why cut spending or raise taxes when the money creation machine is right there? Historically, this meant clipping coins, lowering precious metal content, or issuing paper notes not fully backed by anything. In the modern era, it's central banks expanding balance sheets and governments spending money that didn't exist a few months earlier. For a while, it feels like a magic trick. Problems get fixed without obvious political pain. Stage 4. Inflate and erode trust. More money chasing the same amount of goods means higher prices. People notice their money buying less. Foreign creditors notice the erosion too and start hedging their exposure. Merchants and savers begin to prefer hard assets, foreign currencies, or gold instead of the empire's official money. Trust erodes. Once trust leaves the building, the currency's value can fall much faster than it ever rose. Stage 5. Reset or collapse. In severe cases, inflation accelerates into hyperinflation. People abandon the currency. Governments are forced into a reset, devaluation, new currency systems, emergency controls, or full-blown monetary reform. The political structure can crack at the same time. People holding the old money are the ones who take the hit. The empire's influence shrinks along with its currency. This is not just theory. The same chain of events has played out repeatedly. Take Rome in the 1st to 3rd centuries AD. Rome overextended its military, built a massive bureaucracy, and kept the population pacified with free grain and entertainment. To pay for it, the government debased the denarius. Introduced around 211 BC as a high-purity silver coin, it stayed above 90% silver into the 1st century AD, then slid below 60% by around 200 AD, and down to roughly 5% by around 300 AD. Prices exploded, soldiers demanded payment in gold or physical goods, and confidence in the imperial currency collapsed. That monetary breakdown was a major piece of the Western Empire's eventual collapse in the 4th and 5th centuries. Then Spain, from the mid-1500s to the early 1600s. After conquering the Americas, Spain was flooded with silver and gold from the New World starting in the 1540s. The crown taxed these inflows, and for a time, Spain was the richest empire in Europe. But instead of building a robust, productive economy, Spain spent on wars and imports, ran chronic deficits, debased its coins, and defaulted on its debts in 1557, 1560, 1575, and 1596. The Spanish real lost much of its value. Within a few generations, by the early 1600s, Spain had slid from dominant power to fading legacy. Then Britain, from 1945 through the 1970s. Britain left World War II in 1945 on the winning side, but financially exhausted. Under the post-war Bretton Woods system, sterling was pegged at about $4.03 per pound, until a 30% devaluation in 1949, and it was devalued again in 1967. Through the 1960s and 70s, the government tried to fund both an expensive empire and a generous welfare state, printed money, and endured double-digit inflation, peaking near 25% in 1975, culminating in an IMF bailout in 1976. Over the post-1945 period, the pound lost the vast majority of its purchasing power. In real terms, sterling surrendered reserve currency status to the US dollar and transitioned from global anchor to a managed declining currency. Overspend, borrow, print, inflate, reset. Different places, same pattern. Each time, ordinary savers in the local currency paid the highest price. So, where does the US dollar sit on that curve? Short answer, deep into borrow and print, already living with inflate. Look at the signals. First, debt. US national debt is now over $36 trillion and climbing. Debt to GDP is above 120%. A level that historically correlates with slower growth and higher risk interest on the debt, has become one of the biggest line items in the federal budget, competing with everything else the government wants to fund. Meanwhile, there is no serious consensus about cutting spending or significantly increasing revenue. The path of least resistance has been borrow more. Second, money creation. This is the modern version of debasement. The Federal Reserve's balance sheet grew from under $1 trillion before 2008 to around $9 trillion at the peak after COVID. The money supply, one rough measure, is called M2, jumped by roughly 40% in about 2 years during the pandemic response. That is a massive injection of new dollars into the system in a very short time. Third, inflation. Official consumer price inflation peaked around 9% in 2022, the highest in 4 decades. In real life, many people saw much bigger jumps. Food, rent, energy, cars, and insurance costs rose anywhere from 20 to 50% over a few years. Prices did not rise and then fall back. For the most part, they rose and stayed at a new level. The practical meaning is simple. Each dollar in your pocket now buys less. Fourth, reserve currency strain. For about 80 years, the US dollar has been the world's reserve currency, the main unit for trade and savings globally. That status is still in place, but cracks are visible. Some major economies are settling trade in other currencies. Alliances like BRICS are exploring alternative systems and payment rails. Several central banks have gradually reduced their share of dollar reserves while increasing gold holdings. None of this dethrones the dollar overnight, but it shows a quiet move to hedge against it. So what does all of that add up to for regular people? For savers, it means cash and traditional bonds are losing purchasing power over time. The numbers in the account may rise, but what those numbers can buy may fall faster. For workers, it means wage increases often lag behind cost of living increases, effectively cutting real income even if the nominal salary goes up. For retirees and those approaching retirement, it means fixed income sources like pensions, annuities, and long-term bonds are vulnerable to inflation. The check amount looks the same, the grocery cart it covers does not. For renters and new buyers, it means housing has become less affordable as both prices and borrowing costs rose. For existing homeowners with long-term fixed mortgages at older, lower rates, the situation is more favorable. Debts are being repaid in dollars that are weaker than the ones originally borrowed. If most of a person's wealth is sitting in dollars or long-term dollar promises, the position is uncomfortably similar to citizens in past empires holding debased coins near the later stages of the cycle. This is not a full stage 5 currency collapse, but the combination of heavy borrowing, aggressive money creation, and persistent inflation suggests a late-stage pattern rather than an early-stage one. Historically, this kind of trajectory resolves in one of a few ways. Broadly speaking, the future tends to fall into 3 categories. One possibility is a slow grind, a managed decline. In this path, authorities try to keep things stable enough to avoid crises. Inflation runs above comfort levels, but below total chaos. Debt continues to rise, but restructurings or adjustments are gradual. For families, this feels like each year getting a little tighter, with the standard of living slowly drifting lower unless income grows faster than prices. There is no single dramatic event, but the cumulative effect is significant. Another possibility is a sharper crisis and reset. In this scenario, something snaps. A debt panic, a wave of defaults, a major geopolitical shock, or a rapid loss of confidence in the currency, prices could spike rapidly. Financial institutions might impose temporary controls. Governments might announce devaluations or fast reforms. For ordinary people, this feels like chaos. Savings can lose value quickly, markets swing violently, and the rules seem to change overnight. A third option is a managed restructuring. Political leadership chooses, or is forced, to confront the math. That might involve serious spending cuts, tax reforms, debt restructurings, or changes to the monetary framework. The transition is painful. Higher unemployment for a period, reduced government benefits, and tough headlines. But if the reforms restore trust and discipline, the system can stabilize and rebuild over several years. No one outside the decision-making circles gets to pick which of these paths comes next. But individuals can decide whether they're positioned to be fragile or resilient across these scenarios. Across all 3, one thing is consistently risky: being entirely dependent on a single currency and on long-term promises denominated in that currency. So what does a practical defense actually look like? Think of a 3-layer system: survive, stay afloat, and outrun the problem. Layer 1 is survive. This is the foundation, the stuff that keeps a bad situation from turning into a personal catastrophe. That means having an emergency fund, 3 to 6 months of basic living expenses in relatively safe, liquid form, like a high-yield savings account or a conservative money market fund. Inflation will nibble at it, but in an emergency, the ability to access cash quickly matters more than the yield. It also means reducing fragile obligations. High-interest debt like credit cards or personal loans can become a major vulnerability in any downturn or inflation spike. Reducing or eliminating those balances gives more breathing room. Where possible, it also helps to tame monthly fixed costs, subscriptions, unnecessary recurring charges, and other commitments that raise the household burn rate. Finally, there is a basic resilience piece: keeping a modest stock of essential supplies. That does not mean building a bunker. It means not being one empty shelf day away from panic if there is a supply disruption or sudden price jump. Layer 2 is stay afloat. This is about income and flexibility. Across history, people who navigated inflationary periods best were often those who could keep earning and adjust to new conditions. Skills that are hard to automate, outsource, or replace tend to hold value. Investing time in learning, credentials, or capabilities that improve employability or client value can be a powerful hedge. For employees, that might mean gaining more responsibility in a current role, adding certifications, or positioning for roles in sectors that are more resilient. Networking, keeping a resume up to date, and maintaining a visible professional profile all help increase optionality. For business owners, staying afloat might mean improving pricing power, diversifying suppliers and customers, and reducing dependence on variable rate debt. Businesses that solve real ongoing problems tend to survive better than those relying on cheap credit and easy money. Layer 3 is outrun the problem. This is about asset positioning. Here, the goal is to own things that can hold or grow value even when the currency itself is being diluted. That often includes some mix of productive assets and real assets. Productive assets include ownership in businesses, public stocks, or private companies that can raise prices and maintain margins. Over time, many businesses pass inflation through into their prices, so their nominal revenues and profits rise along with the general price level. Real assets include things like real estate, commodities, and precious metals. These are not perfect or risk-free, but they are not simply numbers in a bank account. Land, property, and certain physical assets have historically moved with or ahead of inflation over long stretches. There is also geographic and currency diversification to consider. Having everything tied to one country and one currency concentrates risk. Some people choose to diversify a portion of their portfolios internationally or into alternative stores of value. Any such move carries its own risks and should be evaluated carefully. None of this is personal financial advice. Every situation is different, and professionals exist for a reason. The point is not that there is one magic asset that fixes everything. The point is that a portfolio made entirely of long-term promises from a heavily indebted, money-printing government is exposed to the very pattern history has shown over and over. A practical way to start is with a simple currency stress test. Set aside 20 minutes and list what you own in broad categories. How much is in pure dollar exposure? Cash, checking, savings, certificates of deposit, and traditional bonds. How much sits in retirement accounts, and what is actually inside those accounts? How much is tied to real or productive assets, home equity, other property, stock or business ownership, and valuable tools or skills? Once those rough percentages are on paper, ask a simple question. If the dollar lost 30% of its purchasing power over the next 5 years, what would happen to this picture? If that thought experiment feels uncomfortable, that is not a reason to panic. It is a signal to start adjusting. That could mean paying down one high-interest debt, starting a small, consistent investment into a broad market index fund, moving idle cash to a better-yielding account, or enrolling in a course that meaningfully improves earning power. The key is not to wait for a crisis headline to start making those changes. The best time to build a defensive position is before the problem becomes obvious to everyone. Empires have been destroying their own money for thousands of years. It isn't a new conspiracy or a modern invention. It's what happens when power meets the ability to create currency, and the discipline to say no erodes. Rome did it, Spain did it, Britain did it. The signs suggest the U.S. is following a similar pattern with the dollar today. No individual can control what central banks or governments decide to do next, but individuals can decide whether their financial lives are standing in the blast radius or quietly moving to higher ground. The aim here isn't to predict the exact day or form of any reset. It's to understand the pattern well enough to avoid being blindsided by the consequences, and to build a personal defense that makes sense for real life. If you're concerned about what happens to your money in times like this, and you'd rather have a plan than a panic, subscribe to Money Margins. This channel is about making sense of the chaos so you can actually protect your future, not just doom scroll headlines.